Hello, this is Bennett Tchaikovsky, and welcome to Adjusting Entries Part 2. We're going to focus today on loans payable and loans receivable. Disclaimer and copyright notice, the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you modify the presentation in any way, please email prior to doing so at 1812cpa@gmail.com to discuss. Note the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. So today, when we're going to be looking here at typical adjusting journal entries or adjusting entries, here we've got cash, loan payable, loan receivable, and cash. We're going to focus on these two today. And what are adjusting journal entries? So when we get to the end of the period, and after everything's been initially recorded, do the assets reflect our future economic benefit? Do our liabilities reflect our future obligations? Revenue reflect what we earned, and our expenses reflect the benefit that we've received during the period. So we're going to do all of our journal entry or all of our transactional entries, and then we do adjusting entries. And once we make them, we got to make sure we're looking at A through D and it makes sense. Most importantly, we never make an adjusting entry that involves cash. Okay, so we've got our first example here, and YYZ is borrowing $100,000 from the Kings on May 1st. The interest rate is 12% simple interest, no interest on interest. And what I mean by that, you don't need to do compounding. What does that mean? Well, 100,000, if it's monthly compounding, you can look that up on YouTube and see what I mean. And the loan and interest will be repaid on April 30th. So here's what we're being asked to do, and I'm going to switch us over to the Google Sheet. Thank you, Google Sheet, for making our lives much easier. Okay, so we're going to enter the transactions into the appropriate T accounts on May 1st, 2019 for YYZ. So over here, we're going to enter these transactions in here. So I've borrowed $100,000, or YYZ has borrowed $100,000. So when we're looking at this journal entry on May 1st, what we're going to do here is we're going to get cash, which is going to be 5/1/19 of 100,000. And then for every debit, I need a credit, and that credit is going to be for a loan payable. And that loan payable is going to be right here for 100,000, and this is also going to be on 5/1/19. So that's the transactions into the appropriate T accounts on May 1st. So that's our first transaction. If this doesn't make sense, go back and watch the earlier videos. So now we're going to enter the adjusting entry into the appropriate T accounts on December 31st, 2019 for YYZ. Okay, so I've borrowed $100,000 and the interest rate is 12% per year. So what I need to figure out is I've borrowed money. And so when I borrowed money, I'm going to have to pay interest. So the amount of interest I'm going to have to pay is going to be my loan amount, which is $100,000, times the interest rate. And here this is going to be 12%. So my annual interest here is going to be $12,000. Now, can I use $12,000? Let's see. My problem is I borrowed the money on May 1st. That is not 12 months. I'm doing the adjusting entry as of December 31st. So in order to do this properly, I need to figure out, okay, this is $12,000 for the year. How many months did I borrow the money for? Now, you want to count this out on your fingers, and if you think I'm kidding, I'm not. But we have May, June, July, August, September, October, November, December, and we got 1, 1, 1, 1, 1, 1, 1, 1, boom. Okay, so right over here, I have a total of 8 months that I borrowed this money for. So what I'm gonna do, if that's the annual interest, I'm gonna multiply this by 8/12, or May 1st through December 31st. Because again, this $12,000 is annual interest for a full year. So here I'm going to multiply this by 8/12. I'm going to get 12,000 times 8/12, or $8,000. So this is going to be my interest expense from 5/1 through 12/31. Now, why do I call this interest expense? Because when I'm borrowing money, okay, when I borrow money, I have to pay interest. The cost of borrowing that money is what we call interest expense. And here, for every debit, I need a credit. Because the loan does not require me to pay back the amount in full until April 30th of the following year, what I'm going to be doing here is I'm going to be crediting interest payable. And so my interest expense is going to be debited for $8,000. My interest payable will be credited for $8,000. Okay, so does this make sense? Well, it does, because remember the 4 questions. One of them was, do the expenses reflect what I used during the period? Prior to this adjusting journal entry, I didn't have anything. There was only this transaction here. But even though the money is not due, I've had the benefit of that money for 8 months. Therefore, what I need to do is I need to record interest expense. How do I record an expense? ERDC, right? Debit, credit, expenses, revenue. Go back and look at the videos, okay? You have to know that stuff coming into here. We're going at a little bit of a faster pace now. Everything's building on each other. So right here, we've got my interest expense is going to be $8,000. And over here, I'm debiting interest expense. And then what do I credit over here? It's going to be interest payable, okay? Even though I may not owe the money until that time, I still need to show the liability that relates to having borrowed that money for those 8 months. So my adjusting entry is going to be a debit to interest expense, and then a credit to interest payable. And for those of you who are new and may just be kind of seeing this for the first time, I will, for your benefit and your benefit alone, okay, so right over here, when I have the cash, my cash is increasing because I'm borrowing money. I show an increase to cash with a debit. Same time, I'm increasing my liabilities because I have to pay back the loan. I'm going to show that over here with a credit. When it comes to interest expense, I record that with a debit. My credit over here is going to be to interest payable. And if I go back over here and look at my typical adjusting journal entries, part of the reason why I wrote this out for you, I gotta fix this one here too, is that this is typically the adjusting entry you do. Now you can memorize these or whatever you wanna do with them, but I would seriously suggest studying them, because when you're borrowing money, this adjusting journal entry generally does not change. So that's what we're doing here. We've gone through and we've recorded interest for the year. Now, to make things a little bit more interesting, what exactly happens? Show the loan and the interest being repaid by YYZ on April 30th, 2020. What exactly is happening here? Okay, so the money over here becomes due, okay? And let's kind of talk about really quickly what happens to interest expense at the end of the period. Well, expenses are part of the income statement, and those expenses are going to be closed out to retain earnings. So when I go ahead here and look at this, and I kind of say to myself, okay, what's going on April 30th, 2020? Well, I still have my loan payable for $100,000. And at the same time over here, I have my interest payable for $8,000. Now, the amount of cash I'm going to have to pay to settle the loan out is going to be how much? Well, if I looked over here at cash, when that loan becomes due, so I'm borrowing that basically, I'm gonna have to pay back a full year's of interest. So my total interest amount is going to be $12,000 plus the loan. So my total cash due is going to be $112,000. When I pay back the loan, I have to pay back over here is going to be, essentially is going to be my interest, which is going to be $12,000 because I borrowed the money from May 1st through April 30th. And so I'm paying back to the borrower essentially $12,000. It's going to be $112,000. So when I pay back the loan, I'm crediting cash here for $100,000. And many of you might be saying, well, Tchaikovsky, why didn't you just show this over here as being loan payable? Because when we're showing the loan, I'm always going to be showing that at the amount that I originally borrowed. The interest payable is always going to be accounted for separately. So when I'm paying this amount here on April 30th, 2020, I'm crediting cash for $112,000 because I have to pay back the principal, and then I also have to pay back the interest. So for every credit, I need a debit. When this balance gets paid off, do I have any remaining balance in my loan payable account? And the answer to that is going to be no. So what I'm going to do is I'm going to debit my loan payable here for $100,000. And now that this balance is also zero, the other question is, do I have any interest payable left? The answer to that is no, because I'm going through and I'm paying back the interest. But here, I only have interest payable on my books of $8,000. So I'm going to credit interest payable here for $8,000. And we're going to denote these here with this green part, okay? And so I kind of come to a problem because whenever I'm doing a transaction, my total debits have to equal my total credits. What am I missing here in 2020? Well, what I'm missing here in 2020 is interest expense. And if you kind of think about it, when we're looking at 2020, did I have the benefit of this $100,000 for a period of time? And the answer is yes. I had the benefit of that interest from January 1st through April 30th. So the other debit I'm going to have is going to be a debit to interest expense. Now here, I could just say, well, I have total debits of $108,000. I have total credits of $112,000. So my interest expense here should be $4,000. And this will be showing essentially over here that I use the money from 1/1/20 to 4/30/20. So what I'm going to do here is I'm going to then say, well, is this amount of interest expense correct? And let's just see. So if my loan amount was $100,000 and my interest amount was also over here was at 12%, my annual interest is going to be 100,000 times 12% or 12,000. Now, I had the money in 2020 for 4 months, or January, February, March, and April. So here I've had it for 4 months. And so when I do the interest calculation, this is going to be 4/12, or January 1st through 4/30/20. So this will be 4/12. So 12,000 times 4/12 is equal to $4,000. There's always going to be different ways you can come up with the various different numbers, but it's very, very important to see where these numbers actually come from. So again, when I'm doing an adjusting journal entry for a loan, I borrowed money. So right over here, I put the transactions in a T accounts. Then I'm doing the adjusting journal entry into the appropriate T accounts on December 31st, 2019. What am I doing at the end of the year? Debiting interest expense, and then I'm crediting interest payable. Then what happens when the loan gets repaid? Well, when that loan gets repaid, my cash is going down not only for the loan amount, but for the interest as well. So I'm paying out $112,000 cash. But when I pay back that loan, right, so I'm decreasing my cash with a credit. At the same time, I'm reducing my liabilities because I no longer owe this $100,000 or my interest payable. So over here, I'm going to debit or decrease my liability here. And here with my interest payable, I'm also going to show that as a debit to go down to 0. But the problem I run into is that my total debits do not equal my total credits. So what I need to do here is to figure out, well, what's that extra amount? And that amount is interest expense, or the use of my money from from January 1st through April 30th of 2020. The last thing here is, how should the loan payable and interest be classified on YYZ's balance sheet as of 12/31/19? And so what you want to do here is say, okay, when is it due? If the loan is due within 12 months of the balance sheet date, or 12/31/19, which it is, I'm going to call it a current liability. Why? Because it's due within 1 year. So let's just take a quick break and we'll then go to the next question. Okay, here we're back, and we just did the first example of our loan payable, and here is a second example, which is going to be a loan receivable. So here we have we have LAX loaning money to Expansion Inc. on March 1st, 2019. The loan will not have to be repaid until February 28th, 2021. And again, when we're going through here, when I'm loaning money, I'm debiting loan receivable and crediting cash. And here, my typical journal entry is going to be a debit to interest expense, and then a debit to interest receivable, and then a credit to interest revenue. So let's go through and do the question. Okay, so we've loaned $500,000 to Expansion. And so what I need to do is I'm doing this via T accounts. So here, because I'm loaning money, my cash is going down by $500,000. For every credit, I need a debit, and this is going to be a debit to loan receivable. So over here, and this is a transaction that I'm making here on 3/1/19. So I'm debiting loan receivable for $500,000, and then I'm crediting cash. Okay, so now we're now over here to do the adjusting entry, into the appropriate T accounts on December 31st, 2019 and December 31st, 2020 for LAX. All right, so I made this a little bit more difficult for myself, but it'll be okay. So my interest expense, excuse me, my interest receivable and interest revenue. So when I'm loaning money, I'm debiting loan receivable and crediting cash. After a period of time, the borrower also is going to be owing me interest. So how do I figure that out? Well, my loan amount for 2019, the principal or the loan amount is going to be $500,000. Okay, and at the same time, my interest rate is going to be at 12%. And I'm just using 12% for obvious reasons. Easiest number to divide by 12, but there we go. So over here, my interest rate is going to be 12%. So my annual interest, and what I mean by annual is going to be 12 months, is right here is going to be 500,000 times 0.12 or 12% or $60,000. Now for 2019, I have an issue here because that's not the right amount. 60,000 is not the correct amount. I have not borrowed the money for 12 months. I've borrowed it rather for 10 months. Now what I want you to do is to close your eyes and count this on your fingers. March, April, May, June, July, August, September, October, November, December. 10 months on your fingers. So right over here, so my interest from 3/1/19 through 12/31/19 is going to be, I'm going to multiply this by 10/12. I'm going to get 60,000 times 10/12 or $50,000. So when I'm going through and recording this, my interest receivable is 50,000 and my interest revenue is going to also be $50,000. Wow, good job, Tchaikovsky. Okay, so I've gone through and I've done that. Now, what would happen? How would I then, if I'm looking at this, have I done this part correctly? Well, how do I record revenues? I record them with a credit. Even though the borrower has not paid me, I still need to record that interest receivable because time has passed. So here I'm going to be debiting interest receivable for $50,000. So I've got a debit to interest receivable, a credit to interest revenue. And so when I'm looking at this on my balance sheet though, and we'll just do 2019 first, how would I be classifying this on my balance sheet as of December 31st, 2019? Well, on my balance sheet, if something's due within a year, it's going to be a current asset. However, this loan is not payable until February 28th, 2021. So as of December 31st, 2019, this is going to be a non-current asset for both the interest and the amount of the loan receivable. Okay, let's talk really quickly about what happens in 2020. Well, when we get to 2020, what's going to be here is that, let's kind of talk about here what's going to happen with these accounts. So in 2020, what happens with interest revenue? Well, revenue is a temporary account. So this account is going to be closed out to retain earnings. But what happens to interest receivable? Well, my ending balance as of 12/31/19 becomes my beginning balance of January 1st, 2020. So here I'm going to have an opening balance of $50,000. Now, when I go over here in terms of recording for the 2020, My principal is still going to be $500,000. Remember, I'm not making you do interest on interest. So here my interest rate is going to be 0.12. So my annual interest for the 2020 loan is going to be 500,000 times 12%, or 60,000. So right over here is this. Now, because in 2020, the loan was outstanding for the full year, right? This was not paid off until 2021. The way I'm going to do this is I'm going to say right here, okay, I don't need to make any kind of adjustment here. So right over here, my interest revenue for 2021, or excuse me, for 2020, is going to be this $60,000 because it's a full year. So over here, I've got interest revenue. This is going to be from 1/1/20. Excuse me. My interest, I did this in the wrong place. Sorry, guys. So my interest revenue for this part here is going to be a credit for $60,000. Okay. Again, what happened with the interest revenue at the end of the period last year, this gets closed out to retained earnings. Look at my prior videos on financial statement creation. But here, when I'm crediting here my interest revenue, and this is as of 12/31/20, what am I going to be debiting? Here I'm going to be debiting interest receivable So my, or I should just say this, 1/1 through 12/31/20. So my interest receivable balance at this point in time is going to be $110,000. So I've gone through here and I've got my interest revenue and I've recorded here of interest receivable. Now, what ends up happening as of 2021? So what's going to be happening in here before we answer that question? What is this going to, is the presentation on the balance sheet going to be different for the loan on December 31st, 2020? The answer is going to be yes. Why is that answer going to be yes? The reason is on December 31st, 2020, unlike December 31st, 2019, the loan is now due to me within a year. So it's going to be a current asset on as of December 31st, 2020. So when I look at this on 12/31/19, it's non-current because it's due beyond a year. But if I get a year later, now it's due in like the next 2 months. So for 2020, what exactly would happen? Well, interest revenue would be closed out to retained earnings, and my interest receivable account would continue to accumulate. The last thing we're going to do for this one particular question is now what happens when the client when the borrower actually pays me back. What happens in that situation? Okay, we're back. So now I'm going to the last part of this where the customer is actually paying me back or paying me back for the loan. So how much am I going to be receiving from my customer? Well, right here, the amount of the loan is $500,000. My interest rate is going to be at 12%. So the annual interest is $60,000. However, the customer or the borrower borrowed this for 2 years. So this is for 12 months. I'm going to basically multiply this by 2. And this is going to give me here, this is going to be then be for 24 months of interest. So the amount of cash I'm going to be receiving, my cash received is going to be my loan amount plus the loan interest. So my loan amount here is going to be $500,000. My loan interest is $120,000. So my total cash received is going to be $620,000. So I'm getting cash of $620,000. Okay, so this customer is now paying me back. And so when the customer is going through and paying me back, for every debit, I need credits. If the customer's paying me back, do I still have over here any type of loan receivable left? And the answer to this is going to be no, because they're paying back this loan. So over here, I'm doing this credit over here for $500,000. For the interest receivable, right, and this was as of 1/1/21, my ending balance here of $110,000 became my beginning balance over here. And my loan receivable balance was all the way back from 3/1/19. And this loan is being paid off on 2/28/21. So here, once the loan is paid, they no longer owe me that interest receivable. And so over here, I've got my ending balance here for my interest receivable is going to be 0. Now, as I look at this in terms of my total debits have to equal my total credits, I have a problem. My problem is I have a debit to cash here for $620,000, and my total credits only equal $610,000. So what am I missing? Well, similar to the other questions we looked at, we're going to have interest revenue, which is going to be for another $10,000. And why? This revenue represents essentially the amount of interest from 1/1/21 through 2/28/21, or those 2 months. Let's see if that number is correct, meaning I'm just plugging this in for the particular amount. So here it's going to be my loan amount of $500,000, my annual interest, my interest rate is 12%, so my total annual interest is going to be $60,000 times 2/12, or just January and February, because that's when it's being paid off. So here, 60,000 times 2/12 gives me $10,000. So that represents interest revenue from January 1st, 2020, 2021 through 2/28/21. Remember, whenever I'm recording a revenue, it's got to be for the period of time it relates to. I don't combine revenue. Revenue is closed at the end of every single period. So right over here, revenue is temporary account, so I'm going to close that out. Whereas over here, a receivable, an asset, I do not close out to retained earnings. I'm only closing out those temporary accounts. So I made this question really a lot more challenging. If you're a student in my class, you're probably completely freaking out right now because they're going, oh my God, Tchaikovsky, are you going to do this to me? Well, if you piss me off, I can do anything, but I don't think that's going to happen, like using a cell phone in class. So, but rather what we're going to do here is more than likely, I would probably do something like the repayment of a loan would be like an extra credit question. But I'm more concerned over here that you're able to go through and to handle how you do the initial transaction as well as the adjusting entry. I did those other things here, which are the loan and interest being received by February 28, 2021, just to kind of take you beyond the accounting period that we're going through and seeing. Because if we go, once we're done with one period and we start looking at the next period, we kind of start needing to be thinking intuitively what's going to happen. Well, the revenue and expense accounts get closed out, but those payables and receivable accounts, as well as the other accounts, do not get closed out. So with that being said, Thank you for watching. Please do not forget to like and subscribe. If you have comments or questions, please send them to me at Bennett1812, no, sorry, 1812cpa@gmail.com. Have a great day.